Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay. So maybe we should start. So my plan today is to go through with you quickly what we have talked about this semester, and then go through some, you can call it sort of exercise questions or some sort of questions. You can expect sort of the style of the question out of the final exam. So final will be second week of, is that second week?
Yes.
Something, yeah. Second week of November. And as you should be aware, you are allowed to take some notes on A4 size paper, double size, right? But I wouldn't actually recommend you to write everything down. That will be counterproductive. And you often find that you can't really find, things you can actually copy from what you actually write. Okay, so let's start. So first lecture we talked about introduction, right? So I'll skip that. So the second lecture, we start to really sort of build up our models. We talked about first about how to represent risk, how to measure them, and because we want to measure risk, we talked about the expected utility series, right? So expected utility theory is different from state-by-state dominance, right? As you later see, we care about the stochastic dominance. And it's related to mean variance, but it's not exactly the same. All right? So utility function, as you typically see, is concave, right? Which you have this relationship of the utility of the mean is greater or equal to mean of the utility. And that's sort of the foundation that will give us a lot of properties in terms of why the risk matters, how to measure them, etc. Right? And we talked about the marginal rate of substitution. One important marginal rate of substitution is from your future marginal rate versus your current marginal rate. Right? So your future versus current gives you this measure of the SDF, as we talked about. We'll talk about later. So we talked about lotteries. One thing you probably actually know by now is that the alias paradox we talked about is actually an example of the behavior bias we talked about last week, right? So this is a behavior bias of loss aversion, right? So if there's a loss, you really don't want to choose this. You want to sort of gamble or in terms of facing the losses, right? So if you think about this utility curve, you are risk-taking in the loss region and your risk aversion in the gain region. Okay, so then we talked about the expected utilities, and start off we talk about this very important property, which is called the Jensen's inequality, right? And this is directly from the property of the utility function. So the Jensen's inequality tells you expect utility less equal to utility expectations. And that's equivalent to U double prime is less than 0. So that's utility curve is concave. Right? And then we talked about how do you choose why this is less in the example. Right. Then with this expected utility, now we move on to how to measure the risk aversion. To measure risk aversion, we first introduce this concept of certainty equivalence and therefore risk premium. Right. So certainty equivalence is the certainty level of the wealth that leads you to avoid the zero mean risk. Right? So for example, with this utility function, we calculate what is the expected utility, and we calculate what is the certainty equivalence to set this utility function equals to the expected utility. Right? And then the difference between your initial wealth, which is not taking the risk, and the certainty equivalence that's facing the risk, that's your risk premium. Right, so that's how the risk premium is actually defined. Then if you sort of shrink this risk to a very small level, then you can get the measure of the risk premium. So what we talk about in terms of Pratt arrow approximation is really just shrink this risk to be really, really small. Right? So at the end, what we got is this risk, risk-taking. How much risk you take will be half of the negative U double prime over U prime times expected y to the square. So this is the variance, right? Which means we have this measure of absolute risk aversion is just half of, absolute risk aversion is just the negative U double prime given any level of the wealth over U prime level of wealth. So you know this risk aversion itself is related to what your starting wealth or starting consumption. All right. So to avoid this relation with the starting wealth, we also introduced the relative risk aversion. All right. So relative risk aversion is this risk of absolute risk aversion times your W0 itself. So because the absolute risk aversion depends on W0 and relative risk aversion times of W0. So these W0 often canceled out as we see in our functional forms. So this will be sort of relative to your wealth, how much risk you're willing to take. All right.
What's the difference between absolute risk aversion and relative risk aversion? Can you give a short example?
So yeah, so absolute risk aversion is how much risk aversion you absolutely want to avoid. Right, so it measures, with absolute risk, it measures how much you're willing to actually invest in the risky assets in terms of wealth itself, in terms of absolute value of your money or your wealth. Okay, relative risk aversion is, it measures how much out of your wealth. So in terms, it's a concept of proportion. That's why it's relative, right? You are willing to actually invest. So with relative risk aversion, you often measures what percentage of your wealth you're actually willing to invest in the risky assets. Okay, so with these basic forms of risk aversion, then we first talked about the participation problem. So the upshot of participation problem is that you want to invest as long as your expected so expected the risky assets return is positive. Right? And this is under the expected utility theory. Right? You should know that under the prospect theory, this will be different. All right, so under the prospect theory, it's possible that even if this expected executor is positive, people still don't want to invest. All right? So although we talked about like risk aversion, variance of the risk of these things, but at the first approximation, if everything is governed by expected utility, then only this first order executor matters in terms of participation. But how much to participate depends on the second order, the variance of this executor. All right? So we sometimes say this risk aversion is a second order property. All right, so in the first order, it doesn't really matter because in the first order, if everything is governed by expected utility, you only care about the expectation of risk. Okay. Then we also talked about with a very small risk, how much are you actually willing to invest? So we end up with this formula of alpha star k, right? So which is expected risky asset return divided by the risk aversion times the variance of your risky asset. And you actually will see this again and again in different kind of forms. Right? So this, in here, we derive it in a like very general form because we're just taking the approximations. Later on, when you actually know what the distribution is, for example, x is distributed normally, then you can calculate what this expected executor minus expected executor squared is. That's just the variance. All right? And later on, when you are given the functional form, for example, CRRA utility curve, then you know what this relative risk aversion is. Right? And I actually give you this assignment, you probably need to calculate this as well. Right? So it really starts with very general form in just lecture 2. Okay, so by now I think you should be sort of quite aware of the power utility, which give you the CRA, and the exponential utility, which gives you the CAI. Okay. Then we can talk about stochastic dominance. The reason I want to talk about stochastic dominance is that we want to talk about how to actually choose a risky asset among all the risky assets. Right? So the first order stochastic dominance, you only look at the expected utilities, which means you only look at the CDF of the underlying asset returns. All right, so in terms of graph, you want to pick the one that has CDF that's always lower. The second order stochastic dominance gives you the situation if the expected expected return or expected value of the distribution in the risk is the same, right? Then you look at the second order stochastic dominance, which is true if your second order derivative of this utility function is less equal to 0. Or in other words, the cumulative of CDF will be less. So cumulative of CDF will be less. In terms of graph, you will know this CDF should have this single crossing property, right? So it crosses from below to the CDF of F2, which is the one being dominated. Right. Then with the stochastic dominance, I think I give you a very useful example, which is the Rothschild-Stiglitz theorem, right? So if your risk is pure noise, you don't really appreciate anything that's combined with this pure noise risk. All right, so one example we did is to calculate the diversification strategy in the IID payoffs. And then related to that, you also introduced to this very useful technique of log normalization, or taking the log of the expectations, right? Because we deal with expectation of the utilities very often, or expectation of the random variables, or expectation of the returns, all these things, right? So you can actually just use this formula of log of expectation equal to expectation of the log plus half the variance of log x. And this actually is used quite often later on. Then you also see this first derivation of asset allocation problem given the CAI utility curve. All right, so although the example I give you is CAI, but you can do it with CI as well, the power utility curve as well. Right? So as you can see that this formula is really actually the same as what we derived here, just different notations. Here. Right, so this one actually is the same as that one. Okay, so that's lecture 2. Lecture 3 is probably one of the most important lecture. Yeah, so I might think of later the order of these lectures, because it's the first couple of lectures actually are sort of very important, and it's not easy actually for you to actually understand. But once you understand this, all the rest is much easier to follow. Right? So the third one, we mainly talked about the SDF, right? So we derive SDF from 2 approaches. One is a contingent claim approach, or the state space approach. The other one is maximizing the consumer's utility problem approach, right? So with the either status space approach or consumer utility approach, you can derive this SDF, which in the state space approach is just your state price Q divided by the probability of that state happening, pi s. All right? And with this SDF, we show you how to sort of derive the general asset pricing formula, P equal to expected MX. You should understand, in and out what these M means, X means, and how actually they can sort of be written in different formulas. You can written it in terms of returns, written it in terms of excess returns, all these things. And you can use this to derive the beta formula, use it to derive Kaplan-like equations to actually summarize the pricing formula. Right, so as I said, you can use the state space or you can use the consumer maximization problem. So this utility maximization problem is also quite important because we use it later on in other problems, right? And because of this utility maximization problem, we also see that this SDF in terms of utility maximization is just equal to beta times the marginal utility ratios between CT plus 1 and CT. All right. Then I think we talk a little bit about using this pricing formula to actually price two things. One is market return. The other one is the risk-free rate. Right. So if this pricing formula is true, at least it should be able to apply to these two known assets, the risk-free rate, right, which you can calculate, and you can do the log linearization about this and plug in the numbers to see if this actually works. All right.
So for the first equation, so we take the risk-free rate out of the expect the spread.
You take the risk-free rate out of, yeah.
And what's the assumption for this?
Well, so, okay, so you have expected X and Y, right? So if X is a random variable, Y is a random variable, then you cannot take anything out of it. If any of these inside expectation is not a random variable, it's just a known number, then you can take it outside the expectation. The risk-free rate, well, not necessarily constant, is known. Remember, this is expectation of time t. So remember, in your assignment, first assignment, your risk-free rate is not a fixed number, right? Risk-free rate changes, but it's known every time before you do the maximization. All right, so this actually is, connected with what you do later on in the assignment. Okay, so with the risk-free formula, we can calculate what is the excess return or risk premium in terms of the SDF and in terms of marginal utilities. Right. Then we talked about the risk-neutral probability. We don't actually spend a lot of time using it it's more useful when you talk about assets like options, right? Assets like derivatives, we haven't really talked about it. But the concept of the risk-free, risk-neutral probability, you should actually know, right? Basically, everything is adjusted by this MS, the SDF, divided by the expected M, or you can say it's the risk-free rate, RF, times this SDF times the original probability itself. Right, so you should be aware, if you have the risk-neutral probability, then you don't really need to consider the concavity of the utility function anymore, right? So everything in terms of pricing is just to take the expected value of your return or of your payoff, and the risk doesn't really matter if you use the risk-neutral probability as your underlying probability in terms of taking the expectations. Right, so usually, let's say you have probability of, let's say, 0.3, 0.7, right? So you have 0.3 times the return plus 0.7 times the return, but that's only giving you the expected return, but you cannot really use this in terms of pricing because you also need to consider the concave utility function, consider your risk aversion. So you need the risk premium plus something, right? But with the risk-neutral probability, then all you need to do is to have 0.3 times the return plus 0.7 times the return. Okay, if this 0.3 and the 0.7 is the risk-neutral. All right, then we talked about how to take this pricing formula in terms of risk-free rate and in terms of risky assets to the data with the log linearizations. And the highlight of this is we have this risk premium puzzle or the risk-free rate puzzle. All right, so risk premium puzzle comes from this last equation, which means gamma must be small given this covariance is really, gamma must be big, given this covariance is really small. And risk-free rate puzzle is coming from this equation, right? So even if your gamma is really big, then what you have is, with this very big gamma, what you have is really big risk-free rate that's contradictory to what we actually observe. All right, so even if you want to relax your assumption of what's the reasonable gamma and can sort of take a really big gamma, then you face this puzzle of why the risk-free rate is not as high as what you can sort of derive from the equations. All right, so that's lecture 3. Lecture 4, we talked about the mean variance. All right, but before we talked about mean variance, we talked about this volatility bound. So the maximum of the volatility, the minimum of the volatility is greater equal to the maximum of the Sharpe ratios. Right? And then with this volatility bound, then we talked about what's true in the data, right? So if you formulate the SDF as some random walk, right, then we can use the property that SDF is sort of closely connected to with the risk-free rate. And we can use the pricing formula for the market return as well. So market return gives us the maximum Sharpe ratio, right? So then we can sort of put them into formula, and we see this SDF is very volatile, but most of the volatility is actually unpredictable, right? In terms of the expected SDF, the volatility is really small. So this is basically also a view on the equity premium puzzle we talked about before. All right. Then we go to the mean variance, and we talked about mean variance without the risk-free rate, right? With the risk-free rate. So you need to be sort of aware how to actually do this yourself, even if the mean variance problem is a little bit different from what's in the lecture notes, right? So I mean, a lot of you may be sort of tempted to, let me just copy down these mean variance solutions, and I can sort of just put it on the exam. If you ask me this question, right, I can tell you that wouldn't work. You have to know actually how do you actually solve this, where things are actually coming from, okay? So that if, for example, this problem is different, not just minimizing this, you are able actually to solve it. One example will be in your assignment, right? You have to minimize something else, then you should be able to do it. Okay, so I wouldn't go through the solution. One thing that sort of we can get from the mean variance is that the mean variance, as you see in your assignment, once you are on the mean variance curve, the linear combination is also a mean variance solution. All right. Then we talked about the mean variance with the risk-free rate. Then with the risk-free rate, basically you have the combination of the risk-free rate and the tangent portfolio, right? Instead of just solving this tangent portfolio on the efficient frontier, you have a combination of the risk-free and the portfolio on the efficient frontier. So this is a special case of these two found theorems, right? And then we talk about some empirical evidences. Then we talk about CAPAN. CAPAN can be directly derived from if everyone on the market is a mean variance investor, right? Then you directly have CAPAN. CAPAN is also an equilibrium pricing formula. That means any change in the weight of the risky assets will have the same benefit and the same cost. The benefit is change in expected utilities, expected returns. The cost is in terms of variance, right? So benefit and cost is the same across all the assets, which you can actually just derive with this formula. And that's exactly the CAPAN. Okay, then we talked about the testing of the CAPAN. I think the most important thing okay, yeah, so we talked about this empirical observation of the CAPAN is much flatter than what the theory suggests. And then the most importantly, we talked about how do you use a particular portfolio approach to actually test the CAPAN. Right, so it's the Farmer-Macbeth procedure. Basically, it's making sure every period is also governed by the cross-sectional CAPAN, right? So in every period, alpha should be equal to 0, and the risk aversion should equal to the market excess return. So that's the essence of testing for this lambda and alpha, basically. Right? And you probably seen that in your assignment as well. Right? Yeah, so this is the graph that we say the empirical observed CAPM, which is sort of lining up all these dots, and the theoretical CAPM, which goes through the risk-free rate and the market return, right? So it's much flatter. All right. So that's lecture 4. And then lecture 5, we mainly talk about the APTs and the factor models. We talked about how do you do the multiple representation starting from the one-factor model, starting from the SDF representations, right? So the multi-factor model is just your SDF is characterized by linear model of multiple factors, and your beta pricing model is also a linear combination of multiple lambdas or multiple risk premiums. Then we talked about the APT. Right? APT really is governed by 2 equations. One equation is what is your single asset excess return. Right? Your single asset excess return should be equals to alpha plus beta, some risk premiums, but this can be multiple factors, right? And the second equation is what it should be your expected returns, right? So this is the first equation, which is your single asset return in terms of multiple factors. And your second equation is in terms of expected returns. So expected returns, if APT is true, that means expected return is just beta times the lambda with multiple lambdas. All right. So to actually help you understand how APT works, I give you this example of IBM the Dell. Right. You can actually see that. Right. So it's governed by, what do I mean? It's governed by 2 equations. So this is one equation, right, in terms of individual return. Well, it's a set of equations because you have multiple assets. The second equation is this one, right? So this is the expected return equation. Also, you have multiple assets, so that's why it's set of equations, right? And you can see that you can actually do some arbitrage if APT is violated, right, until APT is true. Right? And APT is only require you for the non-arbitrage conditions. Okay, so because of APT is only require non-arbitrage, you need the non-arbitrage to be really true, and that's, you can say, the environment that's good for APT should be, you have very high R squares in terms of your multi-factor models. All right, then we talked about the finding the factors, things like that. I think you already see part of it in your assignment. All right, so then the last thing we talk about is you can use the statistical decomposition, which is here we talk about the principal component decomposition to sort of approximate for the APT factors. So, the first factor is very clearly the market return factor. Then all the other factors, you can have interpretation accordingly, right? And with these factors, you can sort of find the mimicking portfolio with those factors. So, so in the workshop, I give you examples of, just using the typical utility curve with some log normal distributions. How do you actually derive the SDF? How the SDF is actually look like. It's really also a random variable, right? Because as long as Z is random, all these M is also random. And then you can use this to solve for risk-free rate, solve for the risk premium, etc. I'll just skip this. And we talked about the expected returns that's embedded in CAPM, right? So you can, use expected returns that's calculated from the historical means, or you can use the historical return, expected returns, assuming CAPM works, assuming CAPM dictates how much each individual actually holds the assets. Then we talk about the different implications of these two approaches, right? So this is sort of the application of these models. The highlight, the most complicated thing sort of you can get out of this is this model of you take the estimates from the market as your prior, and then you take your own views to sort of incorporate your views in terms of mean variance maximizations, right? So that's what we talked about essentially here. All right, so that's the application. Now let's move on to lecture 6. Lecture 6 talk to you about this predictability in the cross-section. All right, so we mainly talk about size and the book to market, but you should be aware there can be more of those cross-section predictabilities. So all these, hopefully with your assignment, you already have sort of a deep understanding how things actually work, where they are coming from. All right. So I'm not going to ask you to write a program on the exam, right? But you should know what does this test mean, right? Like what's the value premium? Why there's a premium? How do we actually show there's a premium? Things like that. Then we talked about predictability in the time series, right? So predictability in the time series, sometimes we sort of call it a market efficiency test. Right? Market efficiency tests have this joint hypothesis problems. But if you just simply look at the efficiency, then efficiency, like most of the market, is sort of efficient in terms of time series with very sort of simple, like daily, monthly, kind of annually time series regressions, right? But we talk also about this efficiency is relative, and it has a limit, right? And this limit is closely related with your variance of the SDF. But that's sort of a short run thing, right? But once we go to the long run, then we do find there's a predictabilities, right? But this predictability is mainly about the price changes, not about the dividend ratio changes, right? So we talked about we can sort of decompose your return into two parts. One is sort of the price change or future return change. The other part is your dividend change, right? You can do a one period Shiller decomposition, Shiller-Campbell decomposition to show, that's indeed is the case. So because of that, we sort of use a DP ratio, the dividend yield, to actually predict the future DP or future returns, right? So you do actually indeed find the predictability with the DP ratio, and similarly you can do it with the EP ratio and things like that. All right, so then we sort of discussed what that these predictably mean empirically. All right, so for example, this tells you this is predictable in terms of DP ratios, DP ratio predictable in terms of returns, future multiple period returns, but not future multiple period dividend growth. Right? And so we introduce this decomposition of the DP, and we see that there's a long-run relationship between the future discounted cash flow and the future discounted dividends, right? So because everything is sort of here is assumed to be infinity, so everything we derive here is the long-run relationship, right? And then we talked about what does that mean. Really is a predictability in terms of, you can actually predict the returns, right? If you take the sort of the rational explanation of this predictability, the long-run predictability itself does not really mean the market is not efficient, right? So it can just mean that the dividend or the price change reflects the future expected return changes. So, so we have this graph of this view about the expected return changes based on our facts. All right. Then we talked about, given that returns are predictable in the long run, right? What's the implication of investment horizons, right? Because mean reversion in the model, so you will have the fact that the long run returns are actually less risky, and the market return is actually, the market portfolio itself is actually a very good hedge portfolio to hedge for the opportunity change of it. So hedge for the changes of, or the risk of your opportunity investment opportunity changes, right? So that means given your utility function and the long run horizon, then you should actually invest more into your risky assets because of this mean reversion. So that's the SO allocation. We talked about this intertemporal campaign very briefly, but as I said, I'm not really going to sort of want to, you to sort of get into really details about this model, but you should know about the implication of the model, right? So the implication of the model is you have this additional risk that measures the changes in your future investment opportunities, and you need to sort of hedge for the risk and holding sort of more of the assets in the risky assets, diversify the risky assets such as market return is a good hedge of that risk. Right, then we talked about market timings. All right, so I think the conditional campaign is important because usually, you sort of think of campaign as sort of the unconditional model, right? But you should know that given the market is dynamic, everything depends on your current information, then campaign should really be conditional, right? And you should know, how do you go from the conditional campaign to derive your unconditional version in terms of testings, in terms of the correlation between your beta and your risk aversion gamma, right? So beta can actually change along with your risk aversion. So this is a SDF version of a conditional campaign, and we also talk about the conditional campaign really indicates in sort of unconditional version really indicates a multi-factor model, right? So instead of just single factor model, once you use the instrument or once you go to multi-factor SDF, then your kappa model or single factor model really becomes a multi-factor model. All right. Event studies, well, this is more of sort of empirical applications. You should know, how actually things are sort of aligned, what really is the meaning of information, and sort of how do we calculate AR, abnormal return, how do we calculate the CAR, the cumulative abnormal return, and the average cumulative abnormal return, the CAR. All right, so I think I'll just skip most of this. Well, with the long run, you have, with the long run, you have, instead of taking the CAR, you will be calculating the bind hold abnormal returns, right? Then we start to talk about the information in the markets, right? So we start with this very simple model with your asset allocation problem, but your information is dependent on your own information instead of everyone has the same information, right? So information we sort of represented with some sort of private signal, right? You can see what's the sort of the signal content. Signal content is just how much the variance of your signal is actually explaining the variations in the true price, right? So if this explains a lot, that means your signal is very informative. If explains nothing, that means your signal is just not informative, or everything here is sort of just a random walk. All right, so we talk about two equilibriums, competitive equilibrium, which is that everyone's doing the best given their own signal, and the rational expectation equilibrium, which is everyone is doing the best given their own signal, and the aggregate price, which depends on the signal itself. All right, so the rational expectation equilibrium, given that you depend on signal and the price also depends on signal, so you need to sort of hypothesize a pricing function and verify that in the equilibrium this pricing function is indeed the true pricing function. All right? So here I think a lot of things like look complicated, but really they're not. I think here you really need to sort of know how to sort of calculate the expected returns, how to calculate the variances, how to calculate the conditional variances, how to calculate the conditional expected returns, right? Once you know these, everything here becomes relatively easy. Right? So we talked about this rational expectation theory also sort of is fully informational, which means reveals all the information. But to sort of have the price not to reveal all the information, we need this noisy asset supply. All right? And one thing we talked about in terms of sort of your updating your information or conditional expectation given your new information is to use the Bayesian theory. All right, so Bayesian theory, you just update the mean and update the precision, or just 1 over the variance. Okay. So that's lecture 10. Lecture 11, we really talked about two things. One is this situation of price deviates from fundamental value given that you have heterogeneous belief on the market and everyone can only buy or sell, but not short sale. All right? So what we sort of use to illustrate is to use a very simple risk-neutral model. All right? So given the risk-neutral, everything can be calculated in terms of future expected values. And we find that the future expected values of either of the agents cannot satisfy to be the market price because the market price needs to be the maximum of the valuation for either of the agents, right? So this pricing formula of maximizing the valuation of either of the agents, given they have different structure of the expectations or heterogeneous expectations, sort of allow you to solve for what the price is in the market. All right? So that's the first thing we talk about. The second thing we talk about, we take a little bit deeper look into this sentiment, right? How sentiment can be sort of driven by different things. And we mainly talked about this one thing in behavior bias, which is the prospect theory, right? Prospect theory give you two things. One is loss aversion. You really sort of hate the loss. The other one is the disposition effect. right? So disposition effect means when you are in the regional game, you are more likely to sell the asset because you are risk averse, right? But in the region of the loss, you are more likely to hold the assets because you are more risk taking. And this can be seen in this graph, right? So this is the risk averse region, this is the risk taking region, and around this reference point, which is change equal to 0, we call the reference price, right? You have two different slopes. So slope on here is less than slope on the negative side. So this is what we call the kink in the utility curve, or the loss aversion. Right, so the implication of that is that you will be holding the risky assets less than what the normal model predicts, right? And you have sort of this trading behavior of selling more of the nominal gains and holding more of the nominal losses. And this behavior can lead to the momentum effect we talked about, right? So because your demand will be higher when you have a good news, so that makes your increase in the price less than what the information actually indicates. So that creates the sort of the delayed reaction or underreaction. So you have the momentum effect. And momentum is not only in cross-section, we also can find it in the time series. That's basically, I think, what we talked about. This is the VAR thing. That's the momentum. Yeah, so that's basically what we talked about. If you don't have questions, let's take a rest, then I'll give you some examples. By the way, any questions so far? Yes, I realize once I do the review, there's not a lot of stuff.
是我有个朋友，他就是寒性体质，他就是身体超弱，也怕冷，但是也怕热。哦，对，有这样的人。你去云南吧。不知道他冬天要穿很多衣服，一到山下哇，好热啊！我都不知道他是怎么样活的。
这不是恒温动物，是冬凉夏暖。厌恶的。要有那个网上有很多，就是地理啊什么的数学研究发现什么的，然后他家里又特别有钱，然后结果那个老师说，他很多东西是他发现反的，然后就成为他的弟弟。
哦，真的吗？他说那个把那个，哎，好像你有看那个微信吗？
哦，对对对，我刚看了，忘了。
我不会啊，你看你会。
我试一下。哦对，我要不找你们组的人帮你考。
他们，我跟他们说，但是他们没人理我啊。
我也是上次，一般这种事情不要在群里，你要单独找个人聊，这样各个直播。
我已经有2个人在讨论了，
过去。没有，就不要怕问这个。
Okay, so let's talk about the thing you really concerned about. You truly actually be interested. Well, I'm thinking maybe in the future I should not have final exam.
Why not start with this semester?
That's quite late. All right, so you have 3 forms of questions. True or false? See, that's very easy, right? True or false, which you not only need to answer it's true or false, you also need to give the reasons.
Oh, reason.
So for example, I can say, let me think though. I can say, the risk premium puzzle reflects the fact that market return is too volatile. Is that true or false? The risk premium puzzle reflects the fact that market return is too volatile. True or false? All right, so you need to think about what's the market premium puzzle really was talking about. Market premium puzzle is talking about the return, the risk premium on the excess return on the market, right? You compare it to what? To the fundamental pricing. Right, fundamental pricing meaning the pricing sort of that's coming from the utility function of the consumptions. Right, so the utility function of consumption, because consumption too smooth, because consumption is very smooth, so that the fundamental pricing with consumption cannot generate enough of risk premium that matches what you empirically observe, right? So in terms of SDF, that means the SDF itself is really very volatile, so cannot be matched by the volatility in consumptions. So in terms of market volatility, market is much too volatile to be described with anything that's sort of connected with marginal utility of consumptions. Now let's examine the statement. Is that true or false? It's true, right? The market is much more volatile, too volatile, in terms of describing your market fundamental with the moves of marginal utility curve.
But in the question you asked that you asked that the risk premium
Reflects the fact that the market return is.
It's in the lecture note and the record I released and again. You said that it's quite moot in the condition. I remember you said that in the lecture.
In the lecture, what did I say?
Yes. I can't remember exactly, but you said something that the risk premium is quite moot.
It's quite.
It means that's quite stable.
Quite, no, the consumption is quite smooth. Right, so consumption is smooth, the return is volatile. So the smooth consumption cannot generate very volatile returns. Right, so if you want to talk about covariance, it's that the covariance of consumption with the return is really small because the returns are very volatile, consumption very smooth, so the covariance of these two variables are very small. And you know the risk premium is determined by some gamma times the covariance of return and the consumption changes. Yeah, so if you look at the notes, in your notes you have this, I think in lecture 3, right? You have your risk premium equals to some log beta plus gamma times the covariance of consumption with consumption growth rate with delta C with returns, right? So delta C with returns, that's very small. Right? That's coming from the fact that the consumption is really smooth, the returns are really volatile. Yeah. I mean, I probably wouldn't actually ask you this question because you just think of this, right, on the spot. So let's see some. So I was talking about true and falses, right? Let's see some short answer questions.
So how many points in the true or false?
I don't know.
So I have a question. So like if the answer is true and I write false and then I have the reason, will you see the reason? If you see the true or false, you write it wrong, so you won't.
Yeah, that's hard to judge, right? Because in most cases, I would say in 99% of cases, if you say true or false wrong, it's not very likely you give the reason right.
But sometimes maybe it's because I misunderstand
Yeah, so
the question.
only if, for example, you really mean it's true, and you write the false. So you have a brain outage or something, right? Or you write, your reason is perfect, but your true and false is wrong, then I think you can get most of the points, whatever.
So you will see.
Yeah, so I think most of the points is in explanations, right? True and false give you sort of basic points. Because anybody can guess the true and false, you have 50% of a chance, right? Yeah, so the other way around, I don't see this happen very often. I would say in most cases, this is not likely.
I think it is possible because maybe you ask the question to test if we understand some serial or some points. We understand that, but misunderstanding your question.
Yeah, I mean, from my experience, I rarely see that. Yeah, but if you did it perfectly and then, you really mean to say F, but you forget this, then you write it as T. Well, all right. So let's see this example. Let's start with something simple. All right. So suppose cap and holds. There are no borrowing restrictions. So the mean variance efficient current frontier consists of this risk-free rate, treasury bill, that means risk-free rate, and the market portfolio. Nevertheless, some households foolishly hold stock portfolios that are less than perfectly diversified, show that the Sharpe ratio of an imperfectly diversified portfolio divided by the Sharpe ratio of the market portfolio equals to the correlation of this imperfectly diversified portfolio with the market portfolio. So this looks really complicated. It takes a while to read the question, but it's actually a very easy question. I don't know. This is not a math class, right?
Yeah.
Yeah, so Sharpe ratio, you start with what Sharpe ratio is.
It is the expected return is the same.
What do you mean expect return the same?
Because I remember the formula for stable expected return over variance.
Yeah.
And the formula for correlations is so if we have the same expected return, we can eliminate and it's become equal.
Yeah, I think you're on the right track. I'm not sure what I understand what you actually talk about. All right, so the Sharpe ratio is just expected return, excess return divided by the volatility, standard deviation, right? So the Sharpe ratio divided by Sharpe ratio of the market, so you just flip the market one, right? And well, they are not equal, but we can use CAPN, right? This expects the RIE divided by expects the RME, that's just beta. Okay? So this is just, the ratio is just the beta times sigma m divided by sigma I. What is beta? Beta is covariance divided by variance. Right? So covariance divided by variance, and with this copied down, so I can cancel this sigma m, cancel this 1 over sigma n. And this covariance is just rho of sigma I, sigma m. So I can cancel sigma m again. And this sigma I is also canceled. What I have is just rho.
So even
Is that what you're thinking about?
But I confuse why you give really long explanation about assumption.
What do you mean? I don't want you to solve the math problem. Okay? I want you to solve the investment problem.
Can you turn back the questions? I have it. Why you must explain that all there are no borrowing restrictions and no mean variance.
That's why you can use this CAPM equation with excess returns. Without this condition, you cannot say excess return equal to something. Right? So this is sort of, well, maybe I don't need this, but I want to be precise, right? I don't want you to sort of, after exam, come to me, you can't really write this equation because something. I want me to be better than you. Right. Question? So this is easy, right? But it really tests you, the sort of the definition or concept of these things, right? What's the Sharpe ratio? Why this expected return ratio equal to beta? And why this beta equal to just the covariance of the two divided by variance? And the covariance can be written as rho times the individual standard deviation. Right, so it's a very simple equation, but so they'll test you concept of these things. So as you can see, you cannot, find it on your cheat sheet. Right, it's in the lecture notes, definitely, but it's not something you can actually copy. That's very easy question, right? So is the theory of first order stochastic dominance still valid under the prospect theory? Because you know what the stochastic dominance is, right? You know what the prospect theory is. So the question is just to put the two things together, is the stochastic dominance first order still valid? What's your answer? It should take you only less than 10 seconds. What's the answer? Someone saying no? Come on. Well, if you can't answer this question, you really need to spend a lot of time studying. Because this is basically the easiest, the simplest question I can think of. What should be the answer? Lots of you have this brain phrase, so how do I attack such a question? So what's the definition of the first order stochastic dominance? CDF is below, right? Or yeah, but that's sort of the condition in terms of, but what's the definition? How do we derive the first order stochastic dominance? What do we compare? Remember that? We compare the expected utilities, right? So first order stochastic dominance requires your expected utility of F1 is better than expected utility of F2, right? Which will be true, as you said, if it's CEF is below, or if you expect the U prime is greater than 0. Remember that? If you go to look at notes, right? The marginal utility is positive. That gives you the first order stochastic dominance. If you have F1 is less than F2, and you have W1 dominates W2. So is the prospect series still satisfy that? So if you take the derivative of any point on the prospect utility curve, it's still upward sloping, right? So the marginal utility of the prospect utility curve is always upward sloping, which means it's true. It's still valid. Because this condition requires only if your utility function is increasing. Right? U prime is greater than 0. Is that in lecture 2? Stochastic dominance. Here. It's literally in lecture notes, right? So that's what I mean. That's the easiest question I can think of. You can literally find the answer in the lecture notes. Good? So you're very confident now, right?
No.
Suppose you have factor structure of 2 diversified portfolios, A and B, given by these 2 equations. What are the risk aversion or the risk premium in this market? I think that's the question. So notice these are the betas. All right, so this is the pricing equation when we talk about APT. Okay, and from this, what's the expected returns? of these two assets. What's the expected returns of asset A, for example? What's the expected return of asset A? $1.2, 0.4, 0.15, what's the expected return? Huh. So this alpha, this is called alpha, right? And alpha is what? Alpha is expected return. Because if you take the expectation on both sides, this is mean zero, that's what's left. Right? So you have expected returns of these two. You can write it in terms of expected return equals to the risk-free rate plus this is the beta, and you can solve the lambda 1 and the lambda 2. Easy, right? So this is just, very easily test you the sort of, if you understand the definition of these equations. I believe the tutor actually probably go over a question like this in the tutorial. At least I asked him to. Oh, that's even an easier question. If you try to run the regression OS, right? Ri minus IF on lambda I times 1 plus some random errors, then how do you interpret this lambda? So the question really asks you, if you run a regression of excess return on a vector 1, what is the coefficient mean? What does the coefficient mean? What is this? Average or mean. Right? So that's very easy. Right? So this is just the mean excess return. Now, if you plot your estimate on y-axis against the expected excess return from the CAPM model on x-axis, which portfolio in terms of size of book to market do you expect to lie above the 45-degree line? That's also very easy, right? Which portfolio? Small. High book to value. What do we call them? Small portfolio and a value portfolio. Right? Because of this premium, what does the premium mean? Premium means the observed mean excess return, which is just a lambda hat here, is higher than what the CAPM predicts, the CAPM expected excess return. Right? So if they're the same, it's on the 45-degree line. So these have premium, so they should be above the 45-degree line. See, it's all very easy. Consider n risky assets with the mean vector R bar and the variance covariance matrix sigma an arbitrary portfolio P with portfolio weight WP on the mean variance frontier has this mean mu P and the variance sigma P squared. Find the zero beta portfolio Z for any of those mean variance efficient portfolio. So zero beta portfolio, so zero beta with the mean variance efficient portfolio, right? So beta should be 0, which means the covariance should be 0, and this asset should be on the mean variance efficient frontier. This one's not so easy, but once you understand the question, once you set up problem, it's really very easy. Do you remember, I think in the lecture we talked about what the covariance is in terms of sigma and something? That's in the lecture notes, and I told you should go back and check out if that's the true. I think Badi actually go over it in the tutorial, right? So that's the covariance. So what are we sort of trying to see? Because this is on the mean variance, right? So you minimize the variance of this portfolio. What's the condition? The condition should be, well, this weight equal to 0, 1, and has the covariance equal to 0 with this market portfolio, with this portfolio P. Right, so this second condition is what I talked about in the class about this covariance thing. Right. So I think that's the difficult part actually to sort of understand. This is minimize the variance, and the condition is the covariance equal to 0. And once you have this, you can just set up Lagrangian and solve everything. Right. So what you have is. This is the solution, what the gamma is, what mu z is. Okay. So now you have someone that's maximizing the power utility function with multiple periods, right? And log consumption growth rate. Expect that C plus 1 is growing at G, and you know the variance of the consumption equal to sigma squared, and you have this M is the log SDF, right? We know the fundamental pricing formula is expect the M R equal to 1, right? So you want to derive the risk-free rate, RF, in terms of log terms, and interpret the meaning of this dividend equation, a derived equation. So where do we start? You know this formula can be applied to the risk-free rate, right? So you should start here, right? And because this is O big M, and you can start here and take some log transformation to get the required rate of the, to get the sort of the IF. And the question is, what if I don't know what M is? But you know what M is, right? M is determined by this marginal utility ratios, right? So it's like beta times U prime CT plus 1 divided by U prime CT, right? So you can actually use this to get what the M is in terms of changes, right? So that's how you actually think about the problem. Now let's solve. So we start with this fundamental pricing, and we know what this M is, right? M is just e to the minus rho, that's your beta. And this second part, that's your utility ratios, right? Let me take a log. This is equal to minus rho minus gamma delta CT plus 1 in terms of log. All right? Now I want to take this into this fundamental equation. If I take the log, this is equal to expected log plus half the variance of the log. That's equal to expected MT plus 1 plus RT plus half of sigma M squared. And we know we can now solve for this IF. IF is minus expected MT plus 1 minus half of the variance. And what is this expected MT plus 1? So this, you're talking about this equation. This is minus rho, so this is rho plus gamma, and this delta CT plus 1, that's just G given in the question, right? And minus half of gamma times risk premium times the variance. So that's your risk-free rate, right? Then you just plug in what gamma is, rho is, what G is, what is the risk-free rate, you can solve. And you can see this is really higher than what you should observe on the market. So this is just a version of the risk-free rate puzzle. All right, so given a reasonable gamma, let's say gamma equal to 2, or any other gamma, the risk-free rate you can solve here is much bigger than what you observe. What you observe is about less than 1%. Right? So it's not really difficult. It's just talking about the risk-free rate puzzle you already seen, right? You can derive everything from the definition of this SDF, right? Once you have this SDF, then you just take the log linearization, just in terms of just solving a simple equation. Okay, so I think this is probably the last question. So this is on the sort of very difficult side. I'm not sure, question like this will appear, but it has appeared. So it's sort of, I think it's a good exercise to actually understand fundamentally, even if you cannot solve the whole problem, but you should be able to solve some steps of the problem. Okay? So if you see a question that has sort of multiple parts, usually at least there's some step you can actually solve. Okay? So even if you see a sort of very complicated question, don't be intimidated. Use what you actually understand, solve what you can actually solve. All right? So the question is, you have some asset with a payoff, zero mean the variance, right? And you have informed investor. They don't have any risky asset at the beginning. He can observe V, place the order of amount X, price P, and his utility function is exponential, right? And then you have a risk neutral market maker. He can observe X plus mu. So this is the sort of the supply that sort of have random component, right? Which mu is from the noise trader and zero mean and the variance. Informed trader behave strategically, so he will take the dependence of the price on the order flow into account. So he should have a pricing function that depends on the order flow he actually observes, right? Assume the risk-free rate is 0. Then I tell you, I help you to set up the question. The informed investor has terminal wealth that's basically equals to the valuation minus the price times how much he invests, which is X, right? Assume the market maker uses a linear pricing rule, the price equal to some lambda times the order flow X plus mu. What's the conditional distribution of the wealth? Conditional on V and X. So what's the question ask you? It's basically ask you the expected value of W conditional on V and X. Right? So if you observe V and X, what is expected value of W? So the question really is to solve a conditional expectation problem. You can also solve the conditional variance so that you have the complete distribution. Right? So what is conditional expectation of the V of W, conditional X and V? Well, you have this W here, right? Wealth is just the value minus the price times how much you invest. Given that you know V and X, the expectation is really easy. All you need to do is to plug in the pricing formula. Right? Because you already know V, you already know X, but you don't know P. But P will be according to this pricing formula, which is lambda times the order flow X plus mu. Right? So what's the conditional expectation? That's just conditional X and V. So this is just V minus lambda X times X. Where this U go? Because U is mean 0. Right? So U times X and U times anything, that becomes 0. Right? So because U is the demand and noise trade, the denominator was mean 0 and the variance sigma mu squared. So if you take the conditional expectation of this top equation, that's just this V minus lambda X times X. Right? So at least up to here, it's very easy. Right? It's just, give you what this condition is, calculate the expected conditions. What about conditional variance? Well, conditional variance, now this mu play a role, right? So now we know V is a number, so this doesn't go into the variance equation. So it should be lambda, this X squared times the variance of this part, which is sigma mu squared. Right? Now V is a known number. Right? X is also a known number, but X, because X is X times this mu, so X need to have the X squared here. So now let's do something a little bit more difficult. The informed investor chooses the optimal X to maximize his expected utility. Given your answer above, solve for the